Hello, welcome back to another video. In this video, let's take a deep dive into how the XLY, the consumer discretionary ETF, perform against the SPY during a recession. Once again, this chart is from January of 2008 through the end of 2009. And this red line, vertical red line here, is official announcement by the NBER that we have been in a year-long recession. Okay, the candlestick that you see, the green and the red, that's the SPY. At the worst, over the time frame, the SPY was down 53+%. Brutal. A brutal drawdown that lasts over a year from January of 2008 to March, the first week of March of 2009. 15 months brutal water torture decline. Now, the XLY from the previous video that I did, hopefully you see that, show that it basically, which is the blue line, match the S&P on the way down. But it bounced stronger. So it's definitely one of the better sector to allocate your money at the bottom of the market. And you don't have to time it perfectly, right? From the time that the NBER announced a recession, you literally have 3 months to put your money, to reallocate your money into XLY. And over the next year, you likely will outperform the SPY, okay? The key to this video is to show you that tactical allocation matters. There's no need to buy and hold. You don't have to be a trader to take advantage of the market, to create alpha for your portfolio, to outperform the market. You don't have to, okay? You don't have to. There are times for tactical allocation, to reallocate your money into a certain sector to add alpha to your portfolio. For those that don't know what alpha is, it's the outperform over the benchmark, okay? So here, the purple you see is the XLY. Can you guess what this line is? The red, the pink, I'm not sure. You know, I'm colorblind for a certain extent, so it's hard for me to know for sure what the color is, but to me it seemed like a little bit of between orange and red. Keep in mind, the consumer discretionary ETF contain many things. Think about it. What is consumer discretionary? It's not toothpaste, okay? It's not food. It's not toothpaste. It is traveling, leisure, home improvement, apparel, and restaurant. So for this video, I'm just gonna focusing on restaurant, okay? So, can anyone guess what this stock is that performed fairly well throughout this 2 years time frame? It's McDonald's. Is it a surprise? It should not be a surprise. This is why I stress and wanted and talk about trading McDonald's for the past year plus. It's stable. It will hold up the earning. It's not going to have to cut back on guidance because more people will cut back on more expensive casual dining and trade down for McDonald's. Okay, so it makes sense. Can anyone guess what this ugly purple line is, which at the worst was down 75% plus compared to the SPY? But it also bounced much stronger, right? Timing matters. What do you think this one is? Compared to McDonald's, what is it? Cheesecake Factory. Cake. Okay? Not a surprise, right? Not a surprise. So it makes sense. Once you dive into the component of the ETF, a lot of what happened as far as the component on how they behave will make sense for you. Let's take a look at another one. Starbucks. Okay, another stock that I trade often. How does Starbucks perform? To my surprise, okay, it didn't hold up very well. It basically matched the S&P 500 for the most part. Did even worse, but it come back stronger than the S&P 500. So the key to this, okay, for whatever reason, my apology, the McDonald's, um, let me add back. It's weird how the McDonald's chart disappear. Maybe there's a maximum amount of comparison I can do. Let's add back McDonald's. And okay, and of course now you can see, does that mean that I want to buy and trade and hold McDonald's throughout this entire time frame? The answer is no. It's dead money, right? Sure, it protect on the way down, but at some point, it's time to reallocate that money. So when I talk about tactical allocation, for me, it is simple. Once I hear the official announcement that we are in a recession, I will look to reallocate that money into, could be the SPY, could be the XLY, but for sure into the Starbucks, the cake that have a stronger bounce off the bottom of the equity market and coming out of the recession. So, there's time to own McDonald's, not all the time, and it's time to own something else that will outperform McDonald's by a significant amount, like Starbucks. So for now, I don't mind owning Starbucks right now. I don't mind owning McDonald's right now. But going forward, as we head into a recession in 2024, I'll be much more careful with Starbucks because it will decline. The chart has shown it, okay? It will decline. It is expensive for a lot of people. It's not recession proof. McDonald's, on the other hand, is recession proof. It didn't get crushed in a recession, but certainly it's not going to give you the big bounce at the bottom of the market. If anything, it's dead money for the most part. So timing matters. And as I show you in the chart, you don't have to pick the bottom. There's a few months where you can put your money between the official announcement and likely will outperform the market. It will add alpha to your portfolio. Okay, so you can do this. Doesn't have to be a day trader. Timing matters. The right allocation into the right stocks or sectors matters. Thank you for watching. Bye-bye.